for someone who is looking to buy their first home right now? Maybe I'll start with Rob on this. What are your thoughts, variable or fixed right now?
Well, there's a good argument for taking a 1 or a 2-year fixed rate. If I was in the mortgage market right now, I would probably take a 1-year fixed. Your rate is high because we've got an inverted yield curve, or at least a flat yield curve, which means the interest rates on the short term are the same as, or even higher than the interest rates for the long term. It's very unusual. Usually you pay less to borrow for a year and more for the privilege of getting a lock-in of 5 years. Peace of mind knowing my rate's stable for 5 years, you pay a little bit more for that. Right now, not so much. So it's not a bargain to how to get a 1-year rate. What it is it enables you to renegotiate 12 months from now. And it's possible that the Bank of Canada will be starting to ratchet interest rates down at that point. So you might be able to switch to a variable rate then and ride interest rates going down lower. Now, if you wanted to simplify life, you could just take a variable rate mortgage now, and knowing that it might go up, let's say 0.5 or 0.75 of a percentage point more, and then it might flatline for a while, and then you're going to ride interest rates lower. Just like it's been super painful to have a variable rate mortgage in the past year, you're going to get the flip side benefit of that. Every time the Bank of Canada cuts its overnight rate, your variable rate mortgage is going to go down, 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 down. Now, how quick is that going to happen? I don't know. Could be like a 12 to 18 month waiting period, but there's no way that the Bank of Canada wants to keep rates as high as they are now. What I wouldn't do is go lock into a 5-year rate mortgage right now, because you are basically saying, mortgage rates at the peak, yes, I'd like 5 years of that. Right. I say no thanks. 1 year would probably be quite enough.
Sounds good. And Colin, do you want to add anything?
Oh, it's hard to add much because I agree wholeheartedly on that. I do think either a 1-year fixed or variable over the 5-year term is the better way to go. I would certainly not be locking in these current rates at this point for a 5-year. Mortgage rates tend to move according to bonds. And Rob's mention of the inverted yield curve is important because the bond market is very, very, I'd say pretty efficient. So if you think about it this way, there's a whole bunch of investors out there that are trying to understand what the central bank is going to do, what the economy looks like, and et cetera. And even before the central bank makes policy moves, some of those investors will begin forecasting what they think will happen. And so that's why you see an inverted yield curve where you have shorter term rates higher than longer term rates. And so those investors are already forecasting that the central bank will have to begin ramping down rates in the sort of medium term. So absolutely would not lock in on a fixed rate 5-year mortgage. I do like the strategy of a 1-year, and if not the 1-year, yeah, variable rate for sure.
Sounds good. And it looks like someone in the audience had a question in the Q&A. They wanted to know, with interest rates coming to a peak, will GIC rates also reach a peak shortly? Because GICs have actually been a very popular investment that is talked about in the physicians group as well. And so I'm actually really curious. Maybe I'll start with you, Rob. GICs, a good investment right now?
I think they are. You know what, I've written a lot about GICs lately, and it's getting devoured on the Globe and Mail website. And what I'm learning is a lot of people really don't want to invest in the stock market at all. They'd really like just to have a 5% guaranteed return. Now, I don't want to oversell GICs. They're still giving you returns that are below inflation. Inflation's about 7%, GICs at 5%. But if you had a 5-year GIC, I think inflation is going to be well below 5% by the time you get to the back half of your GIC. So you're going to do okay there. I think they have a role in the diversified portfolio. You could mix them in with your bonds. You could say that I've got, everybody should have an emergency fund, and some of it could be in cash in a high interest savings account, and a block of it could be, say, available in 1 year. You could lock in money now for 1 year and get 5%. I think that's pretty good, but you have to be able to say, I don't need this money for a year. I'm positive, because if you lock your money into a GIC and try to get it out, you are going to take a big time haircut. You won't like what happens to you. So yeah, I'm quite positive on GICs. I don't think they're the ultimate in wealth building, far from it, but I think some of the money in the fixed income portion of your investment portfolio, that's what generically we call bonds, and GICs are fixed income. You could have some GICs in there, and also a role for savings that you don't need access to in the near term. And also, I do think GIC rates are peaking right now. And I think if you wait too long, you could be very, very regretful, because I know this 5% we're getting from 1 year to 5 years. I don't think it's going to be around very long. And I think people are going to be regretful if they didn't grab it up while it's available.
Yeah, and that's a good point, especially for a lot of people who are waiting to park their money somewhere, especially if they're looking to buy some real estate when the opportunity is right. They have been putting it in GICs and high interest savings account, which I've seen some of the high interest savings account are like giving 3% interest as well.
3.75 is the highest high interest savings account rate. If you're in the market to buy a house and you're looking and watching the market carefully, and you might need to jump, don't use a GIC, even a cashable GIC. Use a high interest savings account, so you can go online and go click, 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 and that deposit money goes into your checking account. That's what you want. You want zero risk, and you want total liquidity, complete access 24 hours a day to your money. The best that you get that through a high interest savings account.
Yeah, that's exactly what I was going to mention, that because you know, there's the GICs that you're locking in. There's the cashable GIC that you're going to take a hit on the rate for generally by doing that. But to the point of, it's really important just to think about what your financial needs are going to be in the next year. And if your financial needs are, you know, major expenditure that you need that cash reserve accessible quickly, you're going to have some difficulty if you've locked it into a GIC. To me, if you don't have that, to me, yeah, GIC all day long versus holding cash, the worst thing you can do relative to those options, unless you have a use for that cash. So, you know, GIC, lock it in, try to get that 5% rate. I would also say one other thing, which is Warren Buffett's expression, which is be greedy when others are fearful. Now, I say that saying, you know, you also have to know what you're doing, right? So, you know, I think that's really important. But Warren Buffett's expression, be greedy when others are fearful, is critically important. You know, a lot of folks talk about having a long-term plan to investing. I would also say nobody has a crystal ball. But, you know, I would say if you look long-term, some of the valuations that we passed through earlier this year might look relatively attractive. So all to say, yes, GICs have their place, fixed income has their place, equities have their place. But in my opinion, the diversification is really important. And so what I'm basically saying is don't pull all the money out of equities and put it in a GIC.